guys, welcome to my channel. So before we get started, make sure to hit that like button and also subscribe my channel. What happens when a crypto exchange goes bankrupt? The major downside to cryptocurrency is the risk of loss, which is even more difficult to manage when a crypto company is holding your coins. In November 2022, crypto exchange FTX suffered a major liquidity crisis and filed for Chapter 11. In July 2022, two major crypto trading platforms, Voyager and Celsius, declared bankruptcy. The wave of bankruptcy reached Bitcoin mining as well in December 2022 when a Nasdaq-listed mining company named Core Scientific (CORZ) filed for Chapter 11. But what does that mean for investors? Key takeaways. Cryptocurrency users have limited recourse if the cryptocurrency company that they use goes bankrupt. After the bankruptcies of crypto firms Celsius and Voyager, investors have a reason for concern. Cryptocurrency holdings are not protected by government-backed insurance. Bankruptcies leave crypto investors unable to withdraw. The bankruptcies of Voyager and Celsius highlight the unique risks that cryptocurrency holders and investors face when trusting crypto firms with their funds. These two incidents alone could lead to well over $1 billion in investor losses. Voyager filed for Chapter 11 bankruptcy protection on July 1, 2022. 4. The company said customers should get all U.S. dollar deposits returned but can't say what portion of their crypto holdings will be returned to customers. It claimed it held $1.3 billion in customer crypto assets on its platform as of the bankruptcy filing. Celsius Network, a large cryptocurrency lending platform, filed for bankruptcy protection on July 13, 2022. The filing came about a month after Celsius paused all withdrawals, swaps, and transfers among customer accounts. In a filing with the U.S. Bankruptcy Court in New York, Celsius shared that it owes roughly $1.2 billion more than it has on hand. With Voyager and Celsius customers unable to withdraw their cryptocurrency assets, it's important for cryptocurrency users everywhere to consider any risks of the exchange or lending platform that they're using, if applicable. Cryptocurrency is not FDIC insured. While confusing marketing messages have led investors to believe otherwise, cryptocurrency holdings are never insured by the Federal Deposit Insurance Corps. Investors should know that if their crypto exchange goes out of business, no government agency will make them whole. That's different from a bank, where the government insures funds are up to account and institution limits. The FDIC has gone so far as to require any member banks and financial institutions that engage in any activities related to cryptocurrencies to disclose that activity to the FDIC for supervisory feedback. Stablecoins, a category of cryptocurrency always pegged to a national government-backed fiat currency, also fall outside FDIC coverage. As holders of the Terra USD stablecoin experienced, those currency pegs are not always viable. 8. Who gets priority during a bankruptcy? During Chapter 11 bankruptcy proceedings, there's a clear chain of who gets paid for the remaining assets. Even if a company owes $1 billion more than it has in assets, investors may not be left empty-handed. Under Chapter 11, the bankrupt company must produce a detailed schedule of assets and liabilities, among other financial statements and reports. During the bankruptcy process, the company, lawyers, and a bankruptcy judge work to figure out who gets what. The legal code states that, in general, the first payments are made to secured creditors. Once those obligations are met, funds go to repay debts to unsecured creditors. Investors are nearly last in line when it comes to recovering their assets. When the pool of assets to be returned to individual investors is calculated, everyone is notified of the pro rata share that they will receive. For example, if the company owes $100 million to customers and has $90 million left after paying off debt, then customers would get approximately 90% of their deposits returned. How to recover funds from a bankrupt cryptocurrency company? If you followed Know Your Customer (KYC) requirements and created your account with legitimate information, the crypto company should have your contact information and an accounting of what you're owed on file. If the company goes bankrupt, you should ideally hear from them right away with information on recovering funds. Most companies will employ their own process to distribute funds to customers. That may require you to follow up by completing forms, confirming your address or payment information, and keeping up with any other necessary paperwork to get your crypto or cash returned. While there's a risk that cryptocurrency investors could get no money or crypto back after bankruptcy, there's also a chance that they will get something back, even if it's just a portion of their original investment. Are cryptocurrencies backed by other assets? Each cryptocurrency is unique and follows its own set of rules and features. Some cryptocurrencies, like stablecoins, have assets backing them, while others don't. How do stablecoins work? Stablecoins are a cryptocurrency asset class designed always to be worth the same amount relative to an underlying asset, like the US dollar, the euro, or physical gold. Asset-backed stablecoins, such as the USD coin and Gemini dollar, issue new currency only when new dollar-backed assets are deposited to the backing account. Algorithmic stablecoins use other methods to maintain the pegged value and don't rely on underlying assets for value. Are cryptocurrencies a good investment? Cryptocurrencies are a relatively new asset with an unproven track record. While it's possible that values could go up significantly in the future, they could also fall to zero. It's up to each investor to decide if cryptocurrencies make sense for their financial goals and investment strategy. The bottom line: a bankruptcy at any financial institution that you work with can be stressful, confusing, and costly. In the cryptocurrency industry, customer confusion and losses can be even worse. But rather than panic, it's best to let the bankruptcy process pan out to determine exactly what you'll get back. If you find yourself involved with a bankrupt crypto company, keep close tabs on your inbox and mailbox for information on how you can file a claim and get as much of your money back as possible. Sponsored, a digital wallet for all your Web3 needs. From crypto to NFTs and beyond, accessing a wealth of DeFi platforms is simpler than you might think. With OKX, a leading digital asset financial service provider, you can access world-class security as you trade and store assets. You can also connect existing wallets and win up to $10,000 when you complete a deposit of more than $50 through a crypto purchase or top-up within 30 days of registration. Learn more and sign up today. Celsius operated much like a bank, taking customer deposits and lending them out or making risky gambles on so-called decentralized finance products to generate high yields. Voyager had a similar model. The company got caught up in the collapse of high-profile crypto hedge fund 3 Arrows Capital, which itself went belly up after defaulting on a $660 million loan from Voyager. Such interconnectedness has left the crypto market vulnerable to contagion, with major firms falling like dominoes as a plunge in token prices. What happens if an exchange fails? Has unwound excessive leverage in the system. Is my crypto safe? Cryptocurrencies aren't regulated, meaning they don't offer people the same protections they would get with money held in a bank or shares in a brokerage firm. For example, the U.S. Securities Investor Protection Corporation insures traders up to $500,000 in cash and securities if a member broker runs into financial difficulties. The Federal Deposit Insurance Corporation, meanwhile, offers bank depositors protection of up to $250,000 if an insured lender fails. There are similar schemes in place in the UK and European Union. With no laws governing crypto assets, there is no guarantee investors would be able to recoup their funds if an exchange were to freeze someone's account, or worse yet, completely collapse. There isn't such a scheme like that at this point for crypto, said Daniel Besikoff, partner at Loeb & Loeb. It wouldn't surprise me if one happens down the line, he added. This will ramp up calls for enhanced regulation. For now, it's still not entirely clear. While there are examples of crypto firms filing for bankruptcy overseas, Mt. Gox in Japan, for example, such an event is unprecedented in the U.S. Creditors of Mt. Gox, which went offline in 2014, are still waiting to get repaid billions of dollars worth of cryptocurrency. The problem with centralized crypto platforms is they can mix different clients' funds together to make risky bets, according to Daniel Sable, a lawyer with Kober and Kim. Such commingling may lead to a ruling that the assets are the property of the exchange, not the users. Users may be surprised to learn that, in a bankruptcy scenario, the crypto and funds held in their accounts may not be considered their own property, Sable says. Exchanges will often pool different customers' crypto and funds together in the same storage wallet or account. What do you think about our video? Let me know in the comment section below. If you enjoyed this video, make sure to hit that like button. Also subscribe our channel before you go. Thank you for watching video.